Friday, May 18th, 2018, Monaco 64, home of alternative economics and contrarian views. I'm going to talk about why I think the era of easy money, easy credit, disinflation is coming to an end and what that will mean. What I think it will mean, it's very difficult to say exactly what do you think the world's going to be like in the next 5, 10, 15 years. We can only look back at the past and try to extrapolate a bit, and also extrapolate that it's going to be very different from what we've had, and that's why it's going to change. Of course, before that, let's have a look at the markets, what we're doing this morning. It's about 8:20 a.m. London. So spot gold has kind of stabilized. It's around 1290. 1290 basically unchanged. The range has been 1287.60 to 1292. Silver's up 2 cents at 1644. Range has been very narrow, 1639 to 1648. The Dow is up 30 points, 24,746, up 0.1%. The S&P 500 is up 3.25 points, also 0.1%, 2723. NASDAQ 100 futures up 15 or 0.25% at 69.16. Currency-wise, the pound pretty quiet as well, 135.09, basically unchanged. The euro is a little stronger, up 0.2% at 118.16. And the dollar is up slightly against the yen at 110.84 yen. Crude oil still quite elevated, 71.68. The WTI crude up 0.2%. And of course, this is going to segue into what I want to talk about easy money. We're seeing a continued spike in the 10-year yield, and it's been rising quite quickly this week. And this week, the high has been 3.13% in the 10-year yield. Right now, we've come off a little bit this morning in London. We're at 310. The quicker it moves, the more impact it could have on the overall markets, overall economy. So it's very important to keep an eye on this. Already, I've seen an article that's come out on USA Today. That's from yesterday afternoon in the US. And it says here, average mortgage rates in the US at a 7-year high. 30-year rate hits 4.61%. So it's already, these rates are going to change as quickly as the 10-year yield changes or the treasury rate changes. Because that's, as I said before, this is what people use as a benchmark for everything else, including mortgage rates. And it says here, long-term U.S. mortgage rates jumped this week, making their highest level in 7 years amid the peak home buying season. The benchmark 30-year rate pushed forward the significant 5% level. Mortgage buyer Freddie Mac said Thursday the average rate on 30-year fixed-rate mortgage was 4.61%, up from 4.55% last week. So, that's why it's so important to keep an eye on those rates. And so now I'm going to talk about why I think things are changing and why I think not even the Fed can stop this. I think I've used this analogy before of King Canute. Not even King Canute could stop the tide. And I don't think even the Fed can stop the tide of tighter credit, inflation, not disinflation anymore. The era of easy money will be over, and we need to go back to basically 1980, 1981, because that was the last, that was the bottom of the last bear market in bonds. When the 10-year yield reached almost 16%. And at the time, I was alive back then. A lot of you weren't, but the 70s was not a great decade. You had a lot of inflation, you had stagnation, and by then, most people never thought this would end, that we'd have inflation forever. but it did change. But I don't think anyone could foresee where we would be today. That we'd have such easy money as we've had in the last 37, 38 years, and that we have gone to almost zero interest rates, and in some cases in Europe negative interest rates. And who would have foreseen that we could have gone from a national debt of under $1 trillion back then in the US to over 21 trillion right now? Well, what made this possible? And also the house prices that have gone up, all the consumer credit, all the student loan credit. No one would have foreseen that. But the reason why this has happened is because of the bull market in bonds. And that's led to lenders and investors holding those bonds, because the key thing about a bull market in bonds is that rates are always going lower. They do rise, and there are cycles, but they always making lower highs and lower lows. And what that means to bond prices is that if you buy a 10-year note in 1990 and you think by 1995 rates are going to be lower, you don't have a problem putting your capital into that 10-year note, because you're going to be getting, like, at the time you could get 8%. And if you think things are going to disinflate, we're going to have, not disinflate, but we have disinflation, like lower and lower rates. That means that by 1995, you're getting the 8%, but the yields are down to 6%, and your capital is actually worth more, because that's what people need to understand. When you buy a bond, or a 10-year note, or a 30-year bond, the market price fluctuates. So if prices are always going up, it's in your interest to keep buying this stuff. You could buy it in 1990, and then by 1995, I'm not going to do the exact calculation, but it's going to be worth more than 100, because it's now down at 6%. So you could sell it, at 120. So this is what has encouraged this, and it's done. And the thing is, it spills over into all the other lending markets: the corporate bonds, mortgage bonds, consumer credit, debt. Everything keeps inflating because investors and lenders are comfortable with it. But I'm going to show you now why I think, and of course, nothing in life is for certain, but looking at this doesn't look very encouraging, in my opinion. And that's why I like to look at charts as well, and technicals. I've given you just now, up to now, the fundamentals, how you can build a mountain of debt through easy money and lower rates. And I think it goes back to Alan Greenspan. He by saving the system in 1987 when we had that crash, by flooding the market with money, and also in the 90s by whenever we had a crisis, the US Treasury and the Fed would come in and help the markets. You had the tequila crisis in Latin America, you had LTCM. They're always there to help. But I think, excuse me, 2008, they were there to help. I think that's the last time, though. I don't think they're going to help anymore, because they know everything's turning. And I think this chart will show it to you, that everything's turning. So this is going back 54 years, and it's, I'll tell you where it's from. It's from macrotrends.net. So if you Google 10-year Treasury yield 54 years, you will get that. You can find this as well. And I've drawn on the chart. I've used this the line function there, and I've put a line from the top in I think it was 1981 or thereabouts, just below 16%, and the high basically in 2004, which was at 3%. And and you can see clearly now we're above that. And you can also use the other line from somewhere in the late 80s, and we're breaking up above that. And the other interesting point looking at the technicals, is that the top in January of 2014 was this 3%. And now we are above 3%, and it looks like it's going to be difficult to stop it right now. So that's why I think the tide is turning. And instead of seeing, if you look at the chart, you have the top there in 1981, just below 16%. Then it drops to like 10%. Then it goes back up to just below 14. And then from 14, it drops to like 7. And then it goes up to just above 10. But now, and then, you know, down below 6, and then up to 8, down to almost 4. And you get the idea. The yields keep getting lower, even the highs keep getting lower. But now, with this break above 3%, the significant top we had at 3% in 2014, that's blown out of the water. Of course, it could turn around and go back below there, and I could be wrong. But this is, I don't think it will. Well, it could in the short term, but in the long term, I think we're going to continue to see higher rates. And the low in 2016, in July of 2016, was around 135. I think that will be a generational low. And are we going to have now 30 years of a bear market? Difficult to say. The cycle would suggest so. How quickly will rates go up? Or could we have a bear market that's very short? Could we go and spike up to 8% in the next 2 years? That would be a huge move. But all I think is that people need to be prepared for the era of, harder to get money, or it's not going to be as easy to borrow, in my opinion. And how does that feel? Well, I think it's just going to be, people are going to have to really work hard for the money they get. It's not going to be as easy to do things, to borrow money, to do this and that and that. Maybe the best thing to do is to talk to your grandparents or parents and ask them how it was in the 70s. I don't think, and the other impact it could have, well, it will have, is on asset prices, because asset prices have all as well. The Dow in 1980 bottomed around 800, and we're now at 25,000 almost. And that's been because of interest rates. All financial assets, we've had a financial asset bubble. That's why Wall Street and the City of London, the 1%, have become so mega wealthy, because they have the wherewithal to invest and put it in those financial assets. But I think now that's going to turn, and it's going to be, how is that going to look? Are we going to have a crash and go deflate straight away? I don't know, but I think people need to prepare for that. I'm just giving you my view here. I'm not advising you to do anything. What's going to happen now if bond prices start going down and yields start going up is that we're going to have inflation, the debasement of the currency. And the thing is, we've had the inflation already in the last 38 years. What we're getting now is the money flooding back into real things out of financial assets, because interest rates are going to go up. So I still stick with precious metals, physical, hard assets, and even real estate is something that's a hard asset. The only problem with real estate, you could find that it's very hard to sell it, your real estate, in a time like this, because there's no money around. But generationally, it's always great to have. I mean, all the very wealthy people in the world have land, buildings, and they just go through the cycles. So you need to make sure, if you do put your money into hard assets or real estate or things like that, that you can afford it, that you don't have to sell it, that you have an income outside of that. Watching the markets, keep watching the interest rates. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet, You can also follow me on Steemit, DTube, and on Twitter. And I'll talk to you later. Take care. Bye.